Good evening. A very warm welcome to all of you. Thank you for joining us for the IDFC Institute Data Governance Network webinar, Central Bank Digital Currencies, Asset or Liability. I'm Meena Munshi, Project Manager for the Data Governance Network project at IDFC Institute. IDFC Institute is a research-focused think/do tank based out of Mumbai. As part of the Data Governance Network project, we examine the critical role that data and digital technologies play in economic and governance processes. In today's session, we discuss the emerging phenomenon of central bank digital currencies, their relevance for a country like India, implications for the banking system, monetary policy, and for the privacy of end users. We have with us on the panel today, Mr. Anand Sinha, who is the former Deputy Governor of the Reserve Bank of India. During his tenure at the RBI, he has been in charge of the regulation of commercial banks, non-banking financial companies, urban cooperative banks, among others. He has been closely associated with banking reforms in India and has represented the RBI on various important committees of the Bank of International Settlements. He is also a member of the board of the Securities Exchange Board of India. Our second panelist, Dr. Sabyasachi Kar, is the RBI Chair Professor at the Institute of Economic Growth. He is the co-editor of the Journal of South Asian Development. Professor Kar's research spans macroeconomics, economic growth, development economics, and political economy, with a particular focus on the Indian economy. Our third panelist today, Dr. Hemant Adarkar, is the Technology Advisor and Resident Senior Fellow at IDFC Institute. He also serves as Public Interest Director for NCDEX. He's the chief architect of the core banking solution for Asia's largest cooperative bank and has been a member of the System and Technology Committees of NSDL and NER. Our session today will be moderated by Dr. Niranjan Rajadhyaksh, who is a research director and senior fellow at the IDFC Institute. Before starting the panel discussion, a few housekeeping announcements. The panel discussion will be on for 45 minutes, followed by 15 minutes for Q&A session. We request our participants to type in their questions in the Q&A box, and they'll be relayed to the panelists. In the interest of time, we request you to keep your questions short and crisp. This session is being recorded and will be uploaded on a YouTube channel shortly after it's concluded. Over to you now, Niranjan.
Thank you very much, Minas, and welcome again to this webinar on central bank digital currencies. Thank you to the participants for agreeing to join this conversation and to the audience which has logged in. So I remember after the 2008 financial crisis, Paul Volcker, who was the legendary chairman of the US Federal Reserve, had said that the only financial innovation which has helped ordinary people has been the ATM machine, right? And he was largely talking about the other types of financial innovation, which sort of almost brought the world down. And it's interesting that in the past 10 to 12 years, there has been another wave of financial innovation based on technology. So we've had new payment systems, we've had the entire rise of fintech, we've had cryptocurrencies. And it will really be interesting, that what someone like Mr. Volcker would have said today about this new wave of innovation. Now, one of the main parts of this new conversation on financial innovation and the interface of technology and finance is central bank digital currencies. A lot has been said and written about private cryptocurrencies, but central bank digital currencies has come to the fore in the past year or two. I wouldn't try to define it. First of all, I assume that most people know about, in the audience know about it, but just very briefly, the usual financial system which we live in, individuals and businesses do not have direct access to the central bank balance sheet other than the currency we hold in our wallets or keep in our homes. We operate through the banking system, and the banks have access to the central bank balance sheet. Central bank digital currencies or the promise of them actually changes the entire game, because even you and I can have access to the central bank balance sheet through perhaps individual accounts or some form of access to what we call reserve money. So today we are going to try to get through in some of the nuances of this entire debate, also try to understand where India stands right now. So if I could start by asking each of the participants just to make a 2 or 3 minute opening statement about why central bank digital currencies are important and what it actually, why we should take this seriously. So if we could start with you, Mr. Sinha, what is your view that how important a change would it be if we shift or if central bank digital currencies are actually operationalized in the world?
Thank you, Mr. Rajadhyaksh, and good evening to all the participants. This is a very profound development. In fact, the BIS survey indicates that 80% of the central banks in the world are actively researching on this issue. And we all know that the People's Bank of China is far ahead. In fact, they started well back in 2014. Others have caught up later on, but the other prominent one is Riksbank, the Central Bank of Sweden. And both of them have already put into place pilot projects. And in fact, a very small country, Bahamas, which consists of 700 islands, not many of them are inhabited, but the population is far-flung. And they have actually launched a cryptocurrency, which is known as sand dollar. And RBI is also actively considering. Now, come to think of it, as Mr. Rajadhyaksh explained just now, that what is central bank digital currency? It's just a question of your having access to the Reserve Bank balance sheet, and in a very simple manner, even though operationally it will be different, but in a very simple manner, what it means is that you open an account with Reserve Bank. Now, this is a very simple thing, but it is worth thinking why it has not happened so far. And why is it that it is being looked at very seriously? The reason is that having account with central bank has profound implications from various aspects. The situation has changed now. Three main drivers which are there for this kind of approach. One has to do with the payment systems, and in particular, the dominance in some countries, particularly like in China or even in Sweden. In China, that is Alipay and WeChat Pay, they account for 94% of the mobile telephony. Then again, in Sweden, the use of cash is vanishing rapidly. Therefore, the question arises that is it good for the development? Now, in payment space, what has happened is that we have got what we say walled compounds. That is, you have very dominant payment systems. They are not interoperable. And because of their dominance, they could actually collude among themselves, or they may not be very conducive to financial inclusion because that's a low margin product. If the cash vanishes, as it is happening in Sweden, and if a situation is reached where, let's say, there is an outage or there is a calamity, you have nothing to fall back upon. Therefore, central banks consider it important that they should provide a risk-free asset to the citizens of the country along with cash. So the intention is not to substitute the cash, but to provide a supplement to that, even though in some countries it may happen that it is actually a substitute. So these are the two main things. But the third thing which has really spurred all this is the cryptocurrency and the stable coin. Now, cryptocurrency, of course, is a highly speculative asset. It can't be treated as money. Stable coin has much better credential for that. But then in the history, we have seen that all privately issued currencies have actually debased eventually. So the central banks are worried about monetary stability. And they're also worried about monetary sovereignty in the sense that if these currencies gain precedence, then what happens to monetary stability? And therefore, they want to have their presence. They want their currency to be used. And that is why, to counter the new features of these currencies, they are thinking in terms of digital currencies. Now, quest for CBDC, therefore, is to correct this situation. The idea is to create a payment infrastructure owned by the central bank, which will be an open platform where everybody can come in and join in. That is, the private sector can also come and join. In fact, they are welcome to come and join. And to provide transactions through various instruments in central bank digital currency. It will provide a secure set. It will provide a backup to the privately owned payment systems in case there is a crisis. And apart from that, it will be good for common citizens, and therefore, under certain other additions, it can be good for financial inclusion. And then once you have central bank digital currency, then it has got certain other things which are certainly by no means the driving force, but there are issues like the additional.
Mr. Sinha, perhaps then we can come into some of those more details as the conversation goes on. For now, I'd just like to invite Sabyasachi to, have your opening remarks about why the conversation on CBDCs is important.
Right. Niranjan, you can hear me, right?
Yeah, I can.
Yeah. Thank you. Thanks to IDFC Institute for inviting me. Actually, in terms of the reasons, Mr. Sinha has more or less covered all the reasons. But if I were to look at it as an economist and think what really does all these same reasons, what do these mean for the economy, and why is it important from that point of view? So I'll touch upon mostly the same reasons, but give you a slightly different framework. So we know that digitalization is happening. We are living in a world where increasingly transactions are becoming digitalized. That's something that's part of the technological progress that we see around us. The problem is that increasingly it is being felt that there are a few issues with the digitalization that are not going to make it an optimal system for growth and development. And particularly, I'll touch upon two of these. One is the cost that is involved in this digitalization, and the other is the risk of this digitalization. So basically what an economist will say is that if you bring down costs of any kind of productive activity, that increases efficiency. So in terms of the digitalization that we have now, it's mostly it's being driven by the private sector. Most of it is driven by commercial banks. Although in India, particularly, a large part of the banking sector is with the government, but globally that's not the norm. That's part of what is driving digitalization, and the other part is payment platforms, etc. Like Alipay in China, for example. So the point is that the current infrastructure of digitalization is not very cost effective, and transactions as a result are not easily available to everybody who should be getting. So one of the important reasons for a central bank digital currency is to make this digitalization cheaper, and that happens. That will have a domestic effect as well as an international effect. The domestic effect is, of course, that you can have more financial inclusion, for example. So the effect of this cost is also on international transactions, where we see that. Increasingly, even the Bank of International Settlements is saying that international transactions are becoming more costly because it's based on the banking system. And again, here costs can be brought down by the use of CBDCs. The second point is about risk. Why risk? Because, as I told you, most of digitalization is happening in the private sector. And we know that the one thing about the private sector is that they are sometimes they think there are market favorites, and they're susceptible to risk. So even if they work very well for 90% of the time, there is a chance that 10% of the time they might actually not be able to work. And with transactions and with payments, it's such a sensitive thing that you can't afford them. So central bank digital currency is a backup system which minimizes the risk by providing an alternative to the private sector based digitalization. So I would say these are the two factors.
Thank you. And really, as we go on, I'd love to ask Mr. Sinha the specific question about the risk part of it. But Hemant, if I can come to you, just some opening thoughts from your perch as a technologist and as a person who thinks about technology policy. Why should we think deeply about CBDCs?
See, there are, I think Mr. Sinha seemed to have covered the aspect, though I will sort of look at the technology aspects much more in detail. One is that the millennials, the major group is sort of less and less dependent on cash, right? I mean, they are the biggest debit card user group in the world is, and e-commerce buyers belong to the millennials who do not have to, keep too much cash with them. That's one. And second thing is the way people are investing money in cryptocurrency world over has really shaken the traditional financial systems. And that's one of the reasons, as Mr. Sinha rightly said, that we need to, the central bank needed to look at this space much more seriously. From a technology perspective, I believe that, CBDC is going to create serious challenges, and especially those who are implementing them, the central banks and their technology vendors will have serious challenges. One thing it assumes, even though we are talking about financial inclusion in a positive sense, but it assumes ubiquity of power and internet throughout the country. And even if you are in Masai Mara or something with your family, you want internet systems to support, when you are making a payment to the Safari operator. So, it has to work in South Bombay, it has to work in Cherrapunji, it has to work in Rajasthan desert. In addition, so it available anywhere, 24/7 availability. The whole system should be secure as well as scalable, and of course has to preserve privacy. So these are very important things. We hear a lot of things from the Chinese executives of the People's Bank who said that it's private as far as the parties are concerned, but as far as the central bank is concerned, nothing is private. So we that's all right for a kind of government China has, but it's not done thing in a democratic setup. So, with this, I think we can, of course, talk about more details of security and scalability, but I think these are important issues according to me.
Thank you, Hemant. So, Mr. Sinha, like you gave a very broad sweep about the importance of CBDCs and covered actually a lot of bases. But I just want to pick up one of the threads which Sabyasachi mentioned, that one, it drives down costs, but secondly, that the risk, with the impact on financial sector risk. Now, what is the implication of a financial system where people have direct access to the central bank rather than working through banks? Will it be a threat to financial stability in two ways? One is that will people bypass the existing banking system and therefore disintermediate the banks? And secondly is, if people keep moving between central bank currency and bank money, in times of financial panic, actually will central bank currencies accentuate runs on banks, etc.? And also a bit about the payment system, because that is the public good which underlies a lot of economic activity in a country. That how do you see the both as somebody who's been in the central bank and as somebody who's thinks deeply about financial sector issues, how do you see the risk aspect of the CBDCs? And also, I just want to add a small question to it, that does the Reserve Bank of India Act allow CBDC type thing, or will it have to be amended? That's a much smaller question, but if you could focus for now on the financial stability angle.
Yeah, financial stability angle I would cover from two aspects. One is the bank disintermediation, and another is payment system. Now, let me take up the payment system first. Payment systems are so much digitalized that they are certainly prone to any outage. And the more concentration you have in a system, the chances of a breakdown, of a vast scale breakdown, are always there. And therefore, what you do is you create a backup system. Of course, it goes without saying that even the backup system of central bank can suffer an outage. And therefore, when CBDC is being designed, so first of all, a central bank operated backup payment open platform is there to help in times of crisis, apart from the issues of greater availability and improving financial inclusion by lowering the cost. Also, from a data privacy perspective, of course, one can argue that the government might snoop on that or the central bank might snoop on that, but for that you will have to build safeguards. But the point is, these are not commercial organizations, and therefore they will guard the privacy. They can be expected to guard the privacy better. So, this is from that perspective. Now, let me add another thing, that when we are designing CBDC, and if we really want to, one backup, as I said, is the payment system operated by the central bank. The other backup has to be, and also from the perspective that this is a kind of cash. Now, therefore, it should have some cash-like features, like there must be some offline capabilities. There must be ease in carrying out transactions. For example, you can have a situation where you have two digital wallets with NFC near field communication capabilities. You don't have to do anything. You have just to put them together and transaction will happen. So this is how to cover the risk and also incentivize the lowering of risk by giving more cash-like features. Of course, I must clarify, as it has been stated earlier, that when we shift to this mode, there is no privacy. There is absolutely no privacy. Even in cryptocurrency, there is no privacy because there is a digital trail. All that will happen is if you have details, it is easier to trace. If you don't have details, it will take more time to trace, but everything will be traced. So privacy has got to be provided through technological setups. So this is from the payment perspective. Now, as far as the financial disintermediation is concerned, that is a real possibility. And that is why, in fact, it answers the question which I raised earlier, that why central banks have not opened or not allowed individual accounts or business accounts to be opened. So this is the reason, financial disintermediation. Now, if central bank digital currency has to be there, which of course, by going by current wisdom, it has to be there, then we have to minimize the leakage from the bank liabilities to central bank digital currency. So we have to control it. And a real bad case would be when there is a run on the banks. Now, how to do it? There are mechanisms which have been discussed. One is that you control the demand. And how you can control the demand is by your remuneration policy. That is, for example, China and Sweden are not going to give any remuneration. But there is another side of argument that if you give remuneration, you have a bit of handle on monetary policy also. But if you are giving remuneration, you have to keep it lower than what a commercial bank will do, or you could have a tiered remuneration. And the third way to control the quantum of CBDC is by introducing caps on individual holdings or introducing transaction limits. So these are the ways by which the risk of disintermediation is required to be controlled.
Thank you, sir. Sabyasachi, as a macroeconomist, and Mr. Sinha raised the issue of the central bank balance sheet and conduct of monetary policy. Now, obviously, to manage the economic cycle, the Monetary Policy Authority changes its balance sheet and works through the financial system to affect demand in the economy. How does a CBDC change the conduct of monetary policy? And also, secondly, if you assume that we are in a world of CBDCs, how does a country like India, which has capital controls, especially for Indian citizens holding international assets, will there be risk of significant leakage through the capital controls? are capital controls of any sort possible in a world where you can access, say, the CBDCs of any country?
Right. Let me take up the second part of your question first, because I think that's a very interesting question. So currently, the way capital controls are enforced is that, there's a limit to which we can exchange our currency for international currency, right? Now, I would argue that, in fact, not having a CBDC might lead to some kind of capital control problem. And that is because we may not choose to have a CBDC, but other countries are going ahead with their own CBDCs. And some of these countries will have very strong digital currencies. And given the nature of these currencies, which are available through the digital space very easily, they would be lucrative for sections of our own population. So in fact, it will be difficult to control the leakage of capital if there are very strong CBDCs that are available, other country CBDCs that are available to our population. Now, I would argue that although not a sufficient condition, but a necessary condition to counter this is to have our own CBDC. Because at the very least, you provide a first line of defense, that you provide an option for people to hold if they want to hold a digital currency in their own country. But I would go ahead and say that even beyond that, that is not going to be sufficient. We need to have an international order where there are understanding between countries how these international spillovers. Capital spillovers is one of them, but there are other kinds of spillovers as well. There could be terrorist activities, all kinds of things involved with this. And so there has to be a global understanding on the lines of what you have, say, for trade and investment through the WTO. Now, even there, I would say that for a country like India, to have a say, to have actually look at our point of view, if we have a CBDC, it is going to be easier for us to put our point of view ahead and ensure that these kinds of leakages don't happen. So that's as far as the capital control is concerned. The other one is monetary policy, particularly demand management. I think some other people have already touched upon it. You see, the thing about CBDC is that it is not a homogeneous product. It depends on how you design it. And there are different ways of designing it, which can allow you different ways of making monetary policy more effective. So Mr. Sinha has already touched upon the possibility of interest rate. Whether you give that or not is a decision, of course, but it is potentially one of the ways in which you can make it more effective. Another way of making it more effective is a form of helicopter money. If you, for example, transfer in a situation like we had in 2020, where there was a, following the COVID crisis, if you could transfer directly to people's wallets some amount of CBDC, then there is a direct demand creation there. So, of course, again, this has a problem because there's a problem between fiscal monetary policy. Whether this is fiscal policy or whether the central bank should be doing it is another issue. But technically, it is possible. So these are some of the ways. Another very interesting way, let me point out, is that suppose you have a situation where very similar to what we have now. We have certain sectors which are supply constrained and facing inflationary pressures, whereas others which are demand constrained. Now, till now, monetary policy has not been able to deal with this because it is a very aggregate kind of policy. But with design, what you can do is you can allow CBDCs to be spent on certain sectors and not on other sectors. Whether that is a good thing or not is a different issue. But I think there are all of these possibilities now with CBDC.
Mr. Sinha, would you agree that a CBDC system could help monetary transmission in the sense that the banks are, in a way, especially in special situations, taken out and you're providing money directly to firms and households?
See, CBDC is not absolutely necessary for that. For example, if we are talking about the so-called helicopter money, it has been done in several, for example, in US, they had tremendous difficulties because they didn't have this kind of system that we had. We have been able to do it through Aadhaar and bank accounts. So CBDC per se need not add to that. but it's a better mechanism. You have, you have perhaps a better handle on that. Now, what the earlier speaker was talking about, what is known as smart money or programmable money. That means you direct the use of money in a particular direction. And like something like food stamp of US. Now, if you can do that, it can certainly correct the sectoral imbalance. So I would agree with that. But all said and done, we have to remember that the quantum of CBDC is not going to be so large, in my view, that it's going to be a very important instrument of policy. But yes, on the margin, it can make a difference.
Hemant, we had some preliminary discussion about the challenge of digital privacy, and you said that actually in a CBDC system, there is no digital privacy, or there is no privacy of the individual because the central bank can see your transactions. What are the other types of challenges? And one again is given the entire, besides the technical challenges, there's a geopolitical challenge, perhaps, given the concerns about China and its embedding bugs into its tech, into the technology system which it sells to the rest of the world. If citizens of one country own or hold CBDCs of another country, are these sorts of problems also likely, like through CBDCs? Hemant, you're frozen. So maybe we can come back to Hemant in some time. So just to continue with the issue of the financial system, Sabyasachi, there are two types of discussions going on. One is the retail CBDC, where people within the economy are using CBDCs for their domestic payments and transactions. Hemant, I'll just come back to you if you don't mind. You froze. And the other is the cross-border transactions, right?
Right.
So in terms of sequencing, do you have any thoughts that if a country like India were to test the waters, would it make more sense to try the cross-border sort of payments through CBDCs, or would you think that we should try it out domestically first for retail payments?
Right. This is a million-dollar question because I think, I haven't come across any discussion particularly on this, and I think it's an important thing to think about. My personal view is that, number one, the complexities of having a multi-country CBDC are far more than having a CBDC within your domestic areas. So I think there's a natural propagation of moving from domestic to international. The second thing is, you see, the most, and perhaps this is the most important answer to your question, international acceptance of a particular country's CBDC will depend on the reputation of that country's central bank, not only in the traditional sense, but I think increasingly in the sense of how they're handling their domestic CBDCs. So just as foreign investors look at domestic investors to find out whether there's a good investment opportunity, I think it will make sense for countries to showcase a workable domestic CBDC in order to then attract other countries. You see, other countries have to agree to partner you in that. It's not going to be an automatic thing. So I think the prudent and practical way of going about it would be to first try it out domestically and then go the international way.
Thanks. Hemant, I don't know if you caught my question before your sort of net acted up. Hello.
Yeah, I can. Yeah, so you're asking about other kinds of issues and.
Yeah, it's both the digital privacy issues in a system of CBDCs, and secondly about the risks of holding other countries' CBDCs, especially in these times of cyber warfare or fears of cyber warfare.
Yeah, if you don't mind, I'll just switch off my video to
Sure, Hemant.
Yeah. So basically, I somehow feel that opening an account with the central bank, so the kind of system central bank is going to have, it's going to be sort of a target for domestic and international hackers. So that's a major thing, because it's, Aadhaar, of course, people seem to be sort of, 6,000 attacks cyber attacks per day, but somehow that system is holding up. Data is leaked through when processes are not followed by various government or public sector employees. Now, this is where I have a problem, even because the government is, going to maintain that system, as well as the issue is, we'll require a lot of information security personnel to manage this system. So, which itself is a challenge, getting good information security personnel. Uh, of course, privacy is a major issue, because whatever technology you use, since this is central bank being the sole creator and distributor of CBDC, will actually see the entire sort of transaction flow for all the individuals. So either we say, in an Indian way that, if, okay, government has access to my data, so be it. And we sort of, are okay with it. The other challenges are, of course, in terms of, it's a government project, which I touched upon. And second thing is, such systems for 130 crore people are a bit too much, which are to be operational 24/7. I think, I feel that that's a big challenge. That having a operational system, we understand payments happen, but holding people's cash is a very difficult thing to accomplish technically till now. Now coming back to international accounts, see, again, I find that with personal data bill, whether Indian holding sort of Indian citizens' data held up, which is held abroad, will be again a regulatory issue with the data privacy regulator and RBI. But having said that, if we are able to sort of internationally move money, and Indian citizens are today also having accounts with foreign banks, so I don't see that as a big challenge. But domestically, I think it's a major challenge to operate and maintain such a system.
Hemant, just quick, another question I had for you is that the entire cryptocurrency conversation, or the success or the demand for cryptocurrencies, all of it was built on the blockchain technology. Is that the only option people are looking at for now, or do you see newer ways of arranging the tech base of cryptocurrencies?
Okay, so I have been reading a lot, and I've been interacting with the Indian Embassy business section in Beijing, who have been sort of also studying the Chinese CBDC at great depths. And what they tell me is that there are three possibilities. One is the multi-tiered web architecture, which is standard system proven for big e-commerce sites, big sites like FIFA and all that, which has worked. Second is the public blockchain, and third is the permissioned or the owned blockchain like Hyperledger or Ethereum, which are owned by organizations or a conglomerate of IBM, etc. So the problem there is that beyond 20,000 transactions per minute, no blockchain has, whether permission blockchain, of course, the public blockchain has only 10 transactions per minute, while the permission blockchain, which is the Hyperledger Ethereum types, have only 20,000. This is the published literature. While the three-tier web architecture, multi-tier web architecture can actually scale up. Of course, you have to throw a lot of hardware at it. This is the level of technology at the moment. And see, this whole system has to scale, and scale to unprecedented levels, for 130 crore people, who can access their bank account at any moment. Another challenge is when you want to provide cash-like cash-like features, like storing it in a wallet or storing it in a small device. How will we sort of synchronize it with our account in the CBDC? That is not clear, because the more the resiliency of a system hits upon the integrity of the system. So my the account, the cash which I hold in a wallet also has to sort of be mapped with my account with in the core system. So that is a challenge well known to computer science. Thanks,
Niranjan, can I say just one thing about this privacy issue? Because everybody has talked about it. So I mean, as an economist, I see it as a demand-supply issue. So, and that sounds a bit odd, but let me explain. So there's a demand for privacy and there's a supply of privacy. And here, CBDCs, as we understand, are less private than cash. Now, I don't think, in the next even decade, or I don't know, I mean, whether I'm being pessimistic, we are going to see, I don't think we're going to see a world where it's going to be completely CBDC. It's going to be a mix of CBDC and cash. And I think in a way, an equilibrium can be defined. The central bank will be, when it is supplying both cash and CBDC. And people, if they think that, wherever in whatever kind of activities, some kind of privacy is more important, then they will demand more cash for that. And so the cash to CBDC ratio will get determined from that in some sense.
Okay. Fair enough. I think there are two questions already in, and both are very interesting. The first is by Mandar Kagde, who has his hands deep in tech and fintech policy, finance and fintech policy. So what Mandar is asking is that aren't NUEs, which is the new umbrella entities, better mitigation against concentration risks of non-central bank payment systems than a CBD? And he says RBI has already moved in the direction of NUEs to mitigate concentration risks. Would it be great to have the panelists' thought on this tension between the two policy approaches? Any thoughts, Sabyasachi, on this?
Right. So the first thought that comes is this is so different from what the Chinese are doing, right? So in the Chinese case, you have already very well established private sector in payments as well as mainly in payments, apparently the one of the reasons that the Chinese are going for CBDCs is that they want to control that private sector. They want to limit it and bring in a balance between private and state. In our case, actually, in India, for example, if you consider the banking sector as the payments where most of the digital payments are coming from, half of it is owned by government. So we already have a very large state-owned digital payment system. And we are trying to, in fact, go the other way around. We are going towards more and more private payments. We already have companies like Paytm, etc. But with the new umbrella thing, we're trying to go for the next step. I think ultimately it will have to be a balance between the two. We need the private sector for the dynamism that it brings to this kind of the different kinds of innovations in transactions, etc. But at the same time, as has been discussed, we need a fallback where if there is a problem that arises from the private sector, you have a state-based system which backs up.
Mr. Sinha, would you like to add something about the policy choice between?
The whole idea about NUE was to have a diversification away from NPCI, because the whole thing is concentrated in one institution. And therefore, the idea was to create more NPCI kind of institutions, so as to provide both a backup, that is to reduce the risk, and also to provide competition in the system. So very much that was the idea, and that's a step in the right direction.
The second question is from Anush Kapadia, and I think Mr. Sinha, it would be great if you can have the first go at this. So Anush is professor at IIT Bombay, and he says that not sure that CBDCs are answering the questions asked of them. Payment systems domestically and globally are not broken, so why fix them? I'm just giving the short thing. And he says CBDCs require an odd two-step: introduce a new technology, then limit its demand through artificial tiering to prevent disintermediation. So what's the point of, in a way, first of all, the existing systems works fine, and if you're introducing CBDCs, why have all these restrictions?
When you introduce CBDC, then as we have discussed earlier, there is a serious issue of financial disintermediation, which can lead to financial instability. So the current wisdom is that CBDC is required, if necessary, for various purposes that we have discussed, provide stability and more accessibility to the payment system, as well as to counter the influence of virtual currencies. So therefore, CBDC is required. That's the wisdom. But let me also add that even though so many central banks have jumped into the fray, very few have decided yet to go ahead with it. So it's quite possible that some of them may decide that why to go in for a very cost-intensive technology. And when things can happen in more or less a similar way in the private sector or in government sector or semi-government sector. So certainly there is one should not assume that everybody is going to jump onto this bandwagon. But my feeling is that if some of the countries do go ahead, then being left behind is not a good thing, because the scenario that we are witnessing happening in some of the countries may visit us after a few years. And then to be left behind in the technology may not be a good thing. So my take would be that we should go ahead with that. But at the same time, in order to safeguard, I mean, it's basically a trade-off among various factors, and we have to manage the trade-off.
Yeah, Niranjan,
Yeah,
if
sure.
I may.
Please do.
Yeah, so the way, I'm going to echo what Mr. Sinha just said, but the point is, I think this is a classic coordination failure globally. I think if all countries could agree that we can put this up for some time, then many countries would probably prefer that outcome. But we don't have that world. We have a world where some countries think that it is in their advantageous to them to go ahead and do it. And so then the other countries have to think strategically. And as Mr. Sinha pointed out, and I think I've written about this in places, that if within 5 years we find a world where most international payments are happening through CBDCs, then we'll become non-competitive if we don't have that framework for ourselves. So I think it's in a way a policy failure, if you can call it that, because it is actually quite dangerous for many countries. But nevertheless, they have all decided that the pros and cons, it is probably it makes sense to invest in it for the future.
Yeah, but I think Anush's question specific, Sabyasachi, to yours, what you said is absolutely valid. But his question is, if I'm reading him correctly, is what's the problem you're trying to fix? If the payment systems are robust and they work, why are we talking about introduction of CBDCs and then also saying that through interest rates or ceilings we will restrict the demand for them?
Right.
Sabyasachi, sir, can I answer that? One thing is, Niranjan, is introduction. I mean, the other countries are there for, of course, not to be left behind. But the feeling is that all international payment, there is a hegemony of US dollar, right? So therefore, CBDC is an answer to that, and that's the only sort of answer it's providing to all the questions asked. So, I mean, countries like China are not liking the, any sort of international exchange. The US, I mean, there is an international lack of privacy in terms of US dollar being exchanged, right? So therefore, this whole thing, this question, was asked to me by a lot of people, that why are all the crypto unicorns in sort of, involved in the Chinese CBDC project at a conceptual level. And one of the reasons is even their cryptocurrencies, they want to peg against, some currency away from the US dollar. Yeah, Dr. Sabyasachi, sorry, you continue.
No, I think, just to go back to Niranjan, the point, trying to answer the question. It's true that in India, particularly, the payment system based on the current system is working very well. But I think the reason why different governments are thinking of CBDCs is that there is always potential for a crisis with private sector led systems. So there are issues of breakdown at certain critical points. That's one kind of problem. But there's also the problem of inclusion. While our payment systems are working very well, we know that they're still bank based, and when it comes to, and we are moving towards privatization of banks, right? And if you look at the participation of our private sector banks in inclusion, it's really very limited. So it's kind of, I think the idea is to have a different platform which is complementary to how the private sector, what the private sector is doing, to fill up the gaps that the private sector probably won't be able to fill up.
Okay, thanks. We have just time for that one last round of questions from me, and if we could have very brief answers, because we're almost out of time. So just to turn the focus on India, and recently the Deputy Governor of RBI, Mr. T. Ravi Shankar, he had given a speech and basically saying that, at some point RBI will have to move on the CBDC front. So if I were to ask you a question, that if you had to bet that how much time will it take for us to have and some form of an Indian version of CBDC? Will it be within 1 year, 1 to 3 years, 3 to 5 years, or 5 years and more? And if just in like 1 or 2 sentences, what will be the main roadblock? Will it be regulatory? Will it be technology? So, Mr. Sinha, if you could like to go first.
Yeah, you see, RBI in its efforts will benefit from a lot of work which has already been done. So it may not literally have to invent the wheel. But let me also point out, China is working from 14, and now only they have been able to put in place a pilot project. Similarly, Sweden, they started sometimes in 16, 17, and only now they have been able to do it. Apart from that, the RBI's approach is going to be a phased approach. So my guess would be that some kind of pilot project, though not very extensive, maybe a part of that, they should be able to do it within 1 year. But a full-fledged CBDC we are looking at, the kind which Bahamas has done, that will be years away, even for China and Sweden. For them, it will be maybe a couple of years away. For us, it will be more. And the basic issue, of course, in India, legislative amendment is required. The RBI Act is required to be amended. But the real challenge would be technological, because huge technological issues are involved.
Thank you, sir. Sabyasachi.
Yeah, my take is slightly different. I think that what CBDCs are basically institutional change. a different way of doing using money and thinking of money. And I'm afraid, I think our experience with institutional change in the last decade has not been always very good. Think of the GST, for example. So I would think that the main challenge would be working out the institutional design, and that will take its own time. I really wouldn't want us to hurry and get into something where we are stuck the way we are with, say, the GST, for example, again. And so, enough time needs to be given to work out the institutional change. And so maybe 3 to 5 years is a good time frame to think about.
Thanks. Hemant, last word is yours. What is
Yeah.
your assessment of how long this will take, and what will be the main roadblock?
Yeah, the roadblock, of course, it's a combination of the other two speakers, what they've said, institutional as well as technology, because, both issues are there, both types of issues are there. There'll be regulatory issues as well. The technology, of course, to my mind, is the largest issue, and information security is the issue, because it's this kind of system will be a target of international hacker groups.
And the time frame, Hemant?
Time frame would be 5 years. I mean, if we really want to include 100 billion people in this CBDC, I mean, it's a Garantuan system, Mughal architecture, whatever you want to term it. But I think, security and scalability are the real serious issues.
Thank you so much, Mr. Anand Sinha, Professor Sabyasachi Kar, and Dr. Hemant Adarkar. I think this is a topic which is new. In the past, it's come up in the past few years. There's not a lot of clarity, and I'm quite sure it's going to be an ongoing conversation. But you all did cover a lot of area today, and a lot of pointers about the road ahead for India and the rest of the world. So thank you very much. And with that, we'll close this webinar. Thanks.
Thank you. Thank you, Niranjan.
Thanks. Thanks, Mr. Sinha. Thanks, Niranjan.